Welcome to Tax-Free Retirement. Do you think taxes will be higher or lower in the future? Well, consider this. The U.S. national debt, currently $28 trillion. At current rates in 4 years, $50 trillion, 8 years, $88 trillion. But that's just the tip of the iceberg. Unfunded liabilities. This includes promises made to seniors for Social Security and Medicare, federal debt held by the public, federal employee pensions, and veterans benefits. Currently, $149 trillion. In 4 years, $181 trillion, and in 8 years, $221 trillion. I think it's a safe bet to say government spending is on the rise. Can you visualize $221 trillion? This might help. Picture a stack of $221 trillion $1 bills. That stack would be almost 15 million miles high. That would reach from the Earth to the moon and back 31 times. See, there's only 2 things the government can do to combat spiraling out of control debt: spend less or tax more. The current administration has already tipped their hand. They're raising taxes. So, if taxes are headed higher, the need for a tax-free retirement strategy is even greater. There are generally 3 broad categories of investment accounts. Let's call them buckets. First, the taxable bucket. Tax me now. This includes bank accounts and brokerage accounts, which require you to pay tax on the growth in income. Second, the tax-deferred bucket. Tax me later. This includes 401ks, 403bs, SEPs, IRAs, and TSAs, where taxes are deferred until later. And third, the tax-free bucket. Tax me never. This includes Roth IRAs and Roth 401ks, Roth conversions, and permanent life insurance that's free from any federal, state, or capital gains tax and doesn't cause your Social Security income to be taxed at retirement. The more assets you have, the more you'll want to consider shifting those assets to the buckets on the right. There's only 2 groups that seem to complain about taxes. Can you guess? It's men and women. The point to remember: taxes make a difference, especially if they're headed higher. Let's compare a taxable, tax-deferred, and tax-free investment. Let's take a hypothetical investment of $100,000. Compounded at 6% a year, let's run it out 20 years and assume a 25% tax rate. With the taxable investment, you pay the taxes each year. At the end of 20 years, you'd have just over $241,000. With the tax-deferred investment, you'd pay the taxes at the end of year 20, and you'd receive just over $265,000. But with the tax-free investment, it's grown to over $320,000. This is the appeal of a tax-free retirement. In addition to Roth IRAs and Roth 401ks, one of the cornerstones of a tax-free retirement is IUL, Indexed Universal Life. Just imagine if you could participate in gains when the stock market goes up, without the risk of loss when the market goes down. And it does so while building up a death benefit that your beneficiaries will receive tax-free. Other benefits of Indexed Universal Life include unlimited contributions, tax-free growth, tax-free distributions, use at any time, a death benefit, and loan availability. There are many reasons to purchase an IUL, but Indexed Universal Life is not for everyone. There are some drawbacks. Our complimentary tax-free retirement review will explain the pros and cons and help you decide if Indexed Universal Life makes sense for you. If you feel taxes will be higher in the future, then the question is simply this: are you accumulating money in the right retirement savings vehicles now to avoid this ticking time bomb of higher taxes in the future? If you'd like to keep more of what you make and turn your savings into a tax-free retirement, we invite you to schedule a complimentary tax-free retirement review. There is no cost and no obligation. You have nothing to lose, but quite possibly much to gain. How much? Possibly a tax-free retirement. But first, let's schedule a complimentary 20-minute discovery call